Happy Tuesday, everyone. Rich Swerbinski with the Mortgage Collaborative here once again with the last week in mortgage today. Our weekly walkthrough, all the latest news, updates, relevant info as it relates to the mortgage industry each week. Pleased to be joined by one of our lender members as my co-host. And this week, back in the co-pilot seat, the Executive Vice President for Independent Bank over residential lending and other things, Pat Ervin. Pat, great to see you.
Great to see you too. Happy to be here.
Excellent. Appreciate you doing this. And let's go ahead and get into the conversation. As always, you guys know by now, any comments, thoughts, questions, bad jokes, throw them into the chat of the Q&A and we'll incorporate it into the show. So, Pat, I'm starting with some breaking news. It's, I guess, not news yet, but the rumor is that we're going to get the long-awaited FHA MIP reduction tomorrow. The rumor is 30 bips on the upfront, and it'll be announced at some speech at some college. Your thoughts on this long-awaited news?
Oh, I think it's great. They they had a unique problem of having that reserve account growing up so big that it became embarrassing for them. So they could have done this a long time ago, but it helps. I mean, is it going to dramatically change, what's taking place, the loans that we're doing? Probably not, but it just makes sense that it's more properly priced for the risk they're actually taking on.
The aforementioned reserve fund, I think the last time I saw numbers, it was almost 5 times the where it needs to be legally. So I know some were anticipating maybe a little bit more, maybe something on the upfront, maybe something on the the monthly, but looks like we're going to get 30 on the upfront. And to your point, though, better than a sharp stick in the eye, right?
Yeah, and it'll be helpful. But here they are 5 times. I think the whole industry, including FHA, they're still anticipating is there going to be a recession of some sort, and how severe will that be? And they're the ones that get hit the hardest when there is a recession. And so I'm sure they're cautious that way, but they got plenty. We don't have to worry about them.
Also saw a report, this wasn't in our show notes, just FHA share in the fourth quarter, not surprisingly up, and traditional MI deals kind of down. The loan level price adjustment hit something else I wanted to get your opinion on. I know, one of the opinions of other co-hosts we've had on here is this could move a lot more volume to FHA, and especially maybe some of the stuff over 680. Have you seen that? Do you think that will be an outcome? And does this 30 basis point, obviously that can only help there, right?
All right. Well, now you've got two different sources of loans heading in different directions. So so FHA will become more of a player. However, both Fannie and Freddie are waiving these LLPAs for first-time home buyers. So they're kind of trying to dip into each other's pool of traditional loans, and we'll have to see, when you have a first-time home buyer, what is the best option for them? Their duty to serve and their other pressures being put on all of these agencies is really going after the borrower that they feel that has been underserved for a long time, and so they're trying to use the mortgage industry as a way to address social ills and try to make financing yet more available. So it's going to be an interesting ride, and we're going to line up what's the best for the client, what's the best pricing options, and take the client that direction. So I don't think us as a mortgage industry are going to act any different than we always have, and that is just try to match the client with what's available out there and get them in that house. It's as if somehow the mortgage industry has been against getting a loan for a person. This is the thing that I always have never understood. I can tell you, after being 30 years in this business, that I've been surrounded by killer salespeople my whole life, and they just want the commission, and they're going to try to get any deal they possibly can through. Every deal starts off with, "This is a really good person. We got to do this deal for him." So, I don't know if all of these different changes are going to get more loans than we would have received before, but that is yet to be seen. It's somewhat of a social experiment taking place with mortgage lending.
Really is. This administration's been very, very active in mortgage and trying to achieve broader initiatives and goals. To your point, through some of the policies, but I think like the roadblock they're running into is just my sense is like because of the larger, if it's the debt or the debt ceiling issue that's coming up, like in a lot of the spending that's happened these last few years, like getting new money for something like the mortgage industry, it just seems like, because we were talking about it before we went live. I mean, with the new LPAs, I remember at the time specifically when we got the increases to the cash out in the second home and the investment property in the second home last year, specifically, it was made mention that this was being done to help subsidize changes that were coming in the future. Yet the changes that came in the future seem to self-subsidize themselves with some of the increases in other buckets. Am I reading that right?
Yeah, well, you got borrowers. Let's say the low to moderate income borrower today is already facing a number of headwinds. Their paycheck has gotten smaller in relation to the costs that they have. If you take somebody that's making, 60, $70,000 a year, and you talk about a 40 something DTI, what they have left over for these more and more expensive groceries and gas and all the other things that come into it. It is a challenge, and you lay on top of that a housing shortage across the country because we didn't build houses to the pace we needed to for 10 years. So, I'm not sure that we're going to be able to push as an industry more loans into the lower bands of first-time home buyers and so forth, because the reality is that it's not just getting somebody in a house with a loan; it's them being successful in that home ownership. All the good things of home ownership don't happen if the wealth building, the generational wealth building, all the things we talk about. If we put them in a loan and then they are unable to afford that home, end up with a foreclosure. We actually harm the consumer more than we've helped them. And I think there's a good responsibility you have to think about the long-term success of people that we're putting in homes. I think that's a moral obligation on us. I remember, how many times I've had somebody come to me and say, "How much loan can I get?" And my answer usually was, "I can probably get you more of a loan than you should ever have. Let's talk about what's going to fit in your lifestyle. What's going to make it so that you can be a successful homeowner, and then let's show that true care for the individuals." And I think as a salesperson, you're always going to come out ahead when you take that spot first, that position.
Yeah, you mentioned there's so many headwinds right now to the first time home buyer, affordability being, at the top of the heap. And it does make it tough. And you have other things, the loan level price adjustments now that are creeping. We had some increased credit costs that kind of reverberated through the mortgage industry, kind of trickle down cost increases that we saw
See,
late.
hey, Rich, I have a question for you on that. How can it be that on the same day, all of the credit vendors double their charge? I mean, how is that not some form of collusion? That they all come out and as we've all agreed somehow that on the same day we're going to double the cost to this industry and to the consumer, because most of us were passing it through one way or another, and it boggles the mind, some of the things that take place in our industry, that being one that just goes without really fanfare. Okay, all vendors just doubled, and how about the out of control trigger leads? We talk about protecting the consumer. I served on the CFPB Advisory Council for 2 years, and I hammered away while I was there about these trigger leads. And this is before. Yeah, I mean, and the bureaucrats, they look at it and they're like, yeah, well, it's always been that way. But you know what has changed? And I know we're shifting a little bit here, but you know what's changed in the trigger lead space? Because in all of our careers on this call, you've dealt with this your whole time. And sometimes you got 1, 2, 3, these trigger leads coming in, and some guy, from a faraway state making sweetheart promises. But what has changed is they now can bump the lead against the database of cell phones. So we all used to think that if I pulled the credit report and didn't put their phone number into the credit report, well, then they wouldn't be able to get to them. And there was some truth to that. But that's no longer the case. Instantaneously, when you buy the trigger leads and they run it through a database that bumps it up against cell phone records, that's showing up on the desk of this person with a pre-dialed number that they can call cell phones. So we're getting calls to people that were, real numbers, well over 50 phone calls in the first 3 days. Some of them over 100. And I think this is universal. So we had to change our process and we now do a soft pull on credit reports, and we begin the process with a soft pull, giving the client an opportunity to go and opt out before we move on to the hard pull report and have to complete the process. But we've done away with the trigger lead issue by educating the clients and giving them the option to opt out before we pull the hard pull.
That's good. And it's not surprising that you guys are smart in doing that. Most lenders aren't. And, I'm trying to figure out why, because affordability is such a central issue right now for all the obvious reasons. You have an administration in place that is really motivated to put more people on the margins in homes, and yet they literally just increase the borrowing costs for all borrowers, 680 to 740 or whatever it is, that are basically above 30% down, less than 30% down. And with these credit costs, I agree. Like, to me, I thought for sure, and I remember predicting on this show, that the government would step in and stop this, because it was essentially like an additional like $300 tax on every single person buying or refinancing a home in America. And it was like, it's why there are rules to not have monopolies. And this is a couple, small handful of companies, but clearly just working in concert. You can just picture what those conversations are, with all the legislation about replacing FICO and Vantage score and all this. Like, we're bleeding everybody dry the second with this party still going on.
Well, if the mortgage lenders on this call all got together and talked about what their pricing is going to be and what their margin is going to be, I don't think it would be go under the radar like this has. And there's a question here in the chat here, understanding that you have to eat the soft pull cost. That is correct. You cannot pass through the charge for a soft pull. It's meant as a consumer report and is not eligible for direct reimbursement through the mortgage process. So it's a service. It's just one of the other things that you have to cover. There's a lot of costs that we're covering, with our bulk fees as an industry. We call them the underwriting and processing fee or whatever. There's a lot of things in there. And so, I put it under that category. You're paying for your technology already through your fees. You're paying, all those things. This is just add on to that. So one way or another, anytime a lender has costs, that's going to show up to the consumer.
Is it the tri-merge company lobbyists? Is there something, you're more dialed in than me on MBA, and you've been on the CFPB.
Well, because there's a very thin argument that is the premise for the sale of trigger leads. And that argument is that, well, this way the consumer is going to have choice, and that other choices will be presented to them. And they're supposed to be approached with a pre-approved credit offer. So the theory is that, if you're going to do this, you're going to mail to the client a specific in-writing credit offer that is going to say, we've looked at your credit and you're approved on this loan. So here's a choice. What it's become is just an absolute wild west of horrific promises made from people that do not have the operational discipline or the oversight, because let's be honest about it. You've got banks like myself. Believe me, we have oversight, we have auditing. You just can't get away with anything. But you also have small shops out there that the idea of a regular is going to come in and find out exactly what they're saying to a client in a trigger lead situation on any type of regular basis. It doesn't occur. So then they're out of desperation. They're buying these leads, and out of desperation, they're making promises trying to take them away. The bottom line is, we talk about consumer protection. We talk about privacy rights. The idea that somebody can look into my credit report and see what my activity is that I have never authorized, I have no knowledge of, and they're not anywhere close to me in a marketplace, yet they can look in and see what my activity is and then reach out to my private cell phone number instantaneously. We're just way over it. And there doesn't seem to be a regulatory will to take this on, which, to me, the skeptic in me, the cynic, says that of course not, because it's not glamorous. You find, the bureaucrats, the bureaucracies are created, they grind along with what is, headline grabbing and that. But when it comes to the actual hard work of consumer protection, truly, I find them lacking. So it's just the reality of it is. And I was in the bureaucracy for, and I currently serve in the Mortgage Industry Advisory Board of the state of Michigan. And it's it's a heavy lift to try to get agencies to really dive in, understand, and make real differences.
This is the last week in Mortgage Today. I'm Rich Swerbinsky with the Mortgage Collaborative, this week joined by the Executive Vice President for Independent Bank, Pat Ervin. Pat, on a more positive note, you're a guy that's led mortgage for some really big Midwestern banks, Talmer, Chemical, Independent now. The home building side of our business, home builder stocks have done pretty well against the stock market last 6 months. Home builder sentiment had a big jump in February. Still seems like a challenging environment for home builders to build homes that are affordable for a various number of reasons, but it feels like that part of our industry is at least starting to come around. No?
Well, when you look at, did I read it in the Chrisman report? If you look at the number of starter homes constructed over the decades, they continue to go down as an overall percentage of the number of homes built, and that's really hurting. And it's just the pure economics of it. When you want to go build a house, and if you want to have it on the market for, 150,000 or something in that range, what it takes from land acquisition to all the permitting and the raw costs, the labor costs, and so forth to deliver a home in that price range, and have all the people get paid and all the other responsibility, it's just further and further away. So I think that this manufactured home segment is getting more and more popular. The GSEs are trying to be supportive of that with their new programs they've come out. And I think that, we should see more of the manufactured type home that can reach down in the lower new home price levels. That's going to be helpful and probably an area that will grow, and one that as a lender you may want to specialize in or really look hard at.
That's a great idea because the way that most people think about manufactured homes is not the way manufactured homes will be built and look into the future in a lot of cases. And it absolutely is a way to build a home much more affordably. And yeah, to your point, we see the GSEs embracing. I mean, I think they know they can't control the home building side of things and the size of homes that are being built, but if you could build homes a little bit different and a little bit more cheaply, then that's something that we're going to see the GSE support.
Yeah, and if you can have a development, in neighborhoods of these homes, then you have the kind of more traditional. You can have the, families, starting families, and things like that. Start in these areas. I think that is a way, just through the economics of it. I think we'll see that to start to, gain more. I also wanted to cover, because I know the time is short here, but we all have a decision to make. Because of the very screwy way that they roll out these LLPA changes, as a matter of fact, any changes from Fannie and Freddie, they do it on delivery date, which none of us in the industry work by delivery date. We work by the dates of when I get a client, when can I get a house, when I get a deal, when can I lock them into a rate, when can we close. But delivery date of May 1st for all of these significant changes mean that all lenders are not going to want to get caught on the wrong side of that line. If you have a deal that, if you wait too long to implement these things, now we've decided to implement the loan level pricing adjustments across the board on March 1st, and that's going to be 60 days prior to the delivery date. And we're confident that we're going to have the vast majority of those be able to be delivered in that time frame. And others are, waiting another 15 days, and they want the market advantage of, that 2 weeks or something, which of course can bite you, if you go over that time frame. Because it can be, for some of these borrowers, and not just on the fringes, but some of your mainline borrowers, just think of that really bad borrower that's, a 750 FICO and puts 20% down. They're going to have that one that borrower that none of us want to have.
750 credit and 20% for a house, like
yeah. So you have a 3/4 LLPA change for that borrower coming, and on a $400,000 house, if you don't get that properly charged and delivered on time, that's gonna, well, just look at the industry profitability. That's gonna more than wipe out any hope of profit that you had on that deal. So you got to be all over this, and this new 40% DTI, you got to be ready to move with that. There's still debate over when, if you can change it. and then what kind of disclosing you've got to be able to do. So that implementation is going to be rough. I think that the MBA was trying to sit down with Director Thompson and try to have a delay on this thing, but from what I understand, they had a face-to-face meeting. They requested one. I understand they had one, and that here we are. And I think that meeting is told was last Friday, so we haven't heard anything about a delay. I don't think there's going to be a delay. I think you got to be ready to go and make your decisions, get your pricing engines all lined up, and get that implemented. Just take the change like we have so many times before, and do your best with it.
We're used to it. And thank you, sir. May I have another? But you're going to have, to your point, you're going to have people maniacally at the end of April selling the over 40 DTI stuff. They're going to be selling the 680 to 740 stuff that's all going up. All that's, you're going to be rushing to close that stuff to get it out the door before the end of the month. And then on the flip side, there's going to be delayed closings for the 620 to 679 people. Wait until May to close because there'll be a lesser fee. So it's kind of nuts. But
you put financial incentives out there, work most effectively. And so, like it or not, you're going to have a financial incentive to be on either side of that line, depending on the thing. And it's not going to be tough to hold on to some loans, especially with that kind of differential. Got another question. They want to know how long we wait from the soft pull until we do the hard pull. The bureaus recommend 7 days. We started off with 10 days just to make sure. But if you do 7 days, you should be all right as long as the client does opt out once they know about it and they do the soft pull. I'll tell you this. Just going back to this whole thing about trigger leads, we've actually won deals because we talked to clients about this, and anyone who's experienced it or had somebody else experience the overwhelming phone calls, just by addressing it, we got a whole lot of credibility, and we got people, oh yeah, you guys do that, and the other guys never said anything. Oh good, so you're not, you got to wait so that doesn't happen. Because just think how disruptive it is in your workday. If you got 40 calls today from a bunch of yahoos, how disruptive to your workday is that going to be? So I know we went back to that topic, but I can see we had another question on it.
Yeah, consumer protection. Protect consumers from these phone calls and not just, seemingly exorbitant mortgage fees. But
is there any mortgage client out there that doesn't know that there's more than one choice of us out here?
Right. Mortgage lenders, everybody say, it's a tough market, purchase only really, and trying to differentiate yourself. And sounds like you guys have done that because of the way you educate your salespeople to educate your borrowers up front how to avoid the trigger lead madness. Nobody. But you're right. You made the comment before. I think it's painted by the people who are invested in, keeping it alive as, oh, it's consumer option, drives costs down,
I tell you, and I know I'm biased, and I know there's people on the call that use them all the time. But I go get your own business. That's how I feel. Go do the hard work of a salesperson in the field with developing a reputation, developing long-term relationships with trusted referral sources. I mean, that's the hard work that leads to long-term success. There's just not an easy way around that. And you can make a great living in this business, but the people that make great livings, and I know many at my company and many other companies, the most successful people are the ones that are the promise keepers. They go out and they develop relationships. They're honest, they're hardworking, and they do what's right for the client. And when there's a mistake, they say it, and they help. These are the formula for success in this business. And if you think there's a quick hit, that's a place I can go and get rich, or I can go and make a lot of money. You're going to find, like anything else, that it's hard work and is doing the right thing day after day. And, sometimes it's not fun. Sometimes you just have to grind it out. But those of us that have been here for a career, we're going to go through these changes. We're going to go through this slow market, and we're going to come out on the other end, and we're going to still be earning a living and feeding our families in this industry. And those that are here for quick hit will be ground out like we have so many times in the past.
Words of wisdom from this week's co-host, the EVP from Independent Bank, Pat Ervin. Very, very, very well said, Pat. Can't disagree with the word of that from a guy that has been there, done that, really long, successful career in this industry. And you're a Michigan guy, all the crazy Michigan IMB guys. I would say, I haven't talked to you about in a while about the Rocket, the UWM, and the Suns. You're
Yeah.
just general take on all the Michigan madness up there.
Well, Michigan, this particular now, everybody on this call is going to tell me how their market is so unique, and I don't get it. And this one's competitive, like you can't imagine, is all that. Well, within, literally within about a 20-minute drive of where I sit right now, I've got UWM, and I've got, of course, the Quicken is right here. We've got Home Point. We've got Flagstar. We have four of the major lenders in this country right here, where somehow I've been able to scratch out a living, not working for any of them, in this business for a long time. So I understand competition.
It is crazy, Michigan. I mean, it is, I mean, Home Point, UWM, and Rocket, they're the top three in wholesale, and I think 1, 2, and 5 maybe in overall mortgage production, all right in each other's backyard. It's crazy.
Yeah, yeah. Well, there's a lot of mortgage talent here. That's the good news, is that there's a lot of underwriter and processor, and there's a lot of people in the industry in Southeast Michigan.
And Pat, I want to close, getting your opinion just on some of the regulatory developments. As you noted, you've sat on the CFPB Advisory Council, and seems like they're kind of focused on right now mortgage comparison sites. It seems like not the core mortgage stuff that they've focused on in the past, and more of like the online stuff. And obviously they're still looking strong at the payday stuff and some of the non-traditional lending. But yeah, just any insight you had on the state of the regulatory community as we get into 23 here.
Oh, well, like everybody else, I don't want to get in trouble. I mean, but I don't think the CF. I will tell you this. Uh, I was actually under the former administration for most of my term when I was there for 2 years on the advisory council, and I really thought that CFPB was on a very good footing. I thought it's listened to the industry, it listened to the community activists, it made balanced decisions. I think that the current CFPB has become much more of an activist and much more in favor of enforcement, regulation by enforcement, and just we're back to the thing. Well, just watch who I nail to the wall here, and you all can learn as we go and watch what happens to these guys. So I think that the CFPB losing that case in Chicago a couple weeks ago
I'd be on
was
top
a
of my
good lesson.
RESPA compliance as a mortgage lender. Let's just put it that way, right?
Yeah, yeah, I would be, like anything else, look at yourself first, be your own harshest critic, and address things straight up. And if your regulator comes in, I can tell you this for absolute certainty: no matter what mistakes or what things that are gone wrong, if you identify it yourself first, if you address it first, and you bring it to their attention, and you say, this is something that's been occurring, this is how we're going to rectify it, you will have 100% more credibility than trying to get away with something. You just have to come to the table and look at yourself all the time. And if you made a mistake, and we've made mistakes, and we've written checks to borrowers that have been closed for 2 months because we uncovered a mistake. And the other thing is that, one of the things that I hate doing, but you need to do it, and that is if you self-identify a loan where you made an error and you bring it to Freddie or Fannie's attention, you self-report that. Nobody wants to do that. But if you go years and you never have a self-reported loan to Fannie or Freddie, you got a problem because you don't have credibility.
Pat, how many, just guess, internal and external audits you've been through in your career?
Well, they're ongoing all the time. We have a whole department here that every month. I just got the report yesterday. We're
looking in your window.
Yeah, all the time. We had 0 significant defects and 0 moderate defects for 3 months running now, and I'm thrilled with that. But I have a very experienced and seasoned team here that I would expect that from not that good. That's beyond belief. But you're going to have moderate defects. Usually 20%, because of how crazy it is. But that's mostly what I would expect it to be: 10 to 20% moderate defects. Your significant defects, you got to believe have well below 5%. and not have too many repeats of those. If you got one, you got to make sure you're not going to get it followed by a second one. So I think that it's all about credibility, honesty, and just assume the best when you're working with the regulators. They just got a job to do. They're trying to be as helpful as you can to them. Do not be hostile with regulators or your internal auditors and that stuff. Don't be defensive. Understand they're trying to be helpful, but if you're combative with them, you're going to lose. Okay, they got the bigger stick.
And don't offer to take them out for happy hour after work. I learned that one the hard way. Yeah. So, Pat, really appreciate you joining us this week and just imparting your knowledge on the audience. Great stuff, and thank you.
I appreciate it. Thanks, Rich. Have a great day.
And to our attendees, thanks as always for joining us. So we're here every Tuesday at 2 p.m. Eastern for the last week in Mortgage Today. You can also find us on YouTube and on wherever you get your podcast, search TMC Connect. Until next Tuesday, have a great rest of the week, everyone. Thanks again, Pat.
Thank you.
Take care, bud.